So welcome into day 3 of this boot camp. Sorry, I'm laughing super hard because I forgot to record. But welcome in, you didn't lose out on anything. We were just talking about how you can build consistency, and in order to do that, you need to make sure that you are using a step-by-step process to go through your trading journey. And one way to do this is that you need to boil down all your steps into a trading journey, figure out what you're good at, figure out what you're bad at, and take away the good and bad points. Execute with small risk size, and then backtest your strategy. What do you mean by backtest? This means that, let's say now you have your markers, right? You're going to use your markers as to input into past events that have happened to see if that strategy actually did work, okay? That's what we call backtesting. So you can do this quite easily on TradingView, where you can look at where past action has been and then try to use that. And then after you're done backtesting, now you're ready to see, okay, if I have a pretty decent chance for this setup to happen, okay, now I can start applying it on my trades that are in the future. Okay, so this is one way that I think about it. Now, what does a example of a strategy look like? So I have an example here for you. This is one of my most, I think, in my opinion, best money-making strategies. Consistently, I have had very good results from this specific setup. Now, remember, it doesn't mean that it's going to work for you. It just means that this works for me. I'm sharing it with you, and you can see if it works for you or not. But what are my steps? What do I go through, right? So this setup, you can see I named it the breakaway opener, okay? And what is a breakaway opener? What are the requirements for this? You need a pre-market gap up above a key pivot point with increased volume, pre-market volume, right, on a specific ticker. Then you need to check where the indices are. Where's the dollar index? Where's the VIX? Are there any sector rotations for the day? How do you know there's sector rotations? Look at your market internals, look at the whole list and go through all of them. It takes you all but 2 minutes to do that, right? Where is money moving into for the day? Pre-market, you can always judge that, okay? Now, once you have come up with your general thesis of where the market's going, you can choose a direction, the direction for the play. If the direction of the market is aligned with your potential setup, this gives you the green light to now look for entries and exits. So now your chosen setup must gap up or be above the pre-market level and show significant interest above the previous highs. I'm going to show you what the setup looks like, and then you'll understand, okay? And we're going to also go through other examples. Like, I don't want you to just take away information from this bootcamp. The last day here is about hands-on experience. So we're going to go through a couple of setups here, okay? And then what is your criteria for entry? It's going to be a pullback into the previous day's lows, or entry based on your risk-reward ratio. So an example of how this kind of a setup works. So let's have a look. I think it was PayPal. Okay, so here we go. So for this week, this is the setup that I feel might validate this potential streamline process, right? So you have PayPal that has been approaching a key pivot point at $68, which it got rejected and faked out a bunch of people before. This was a draw on liquidity, okay? So liquidity got pulled into the market here. These were a bunch of buy orders that got stopped out and then pulled back into the market. And then after that, it gapped down on earnings. And since the earnings came out, it bounced on the 57 level very strongly to now get back into the $68 level. So what are we looking for here? We are looking for a potential breakaway setup. What is the breakaway setup? The breakaway setup would mean that PayPal would gap above $68, break above this level here, pre-market. That's the first thing I'm looking for here. What does that mean? That means that there's an overnight consensus change about this stock completely, right? It has gone from being a laggard and now it's going to start rallying. And this will mean that I'll be able to look for an opportunity to go further long on this trade if it gives me a pullback, right? So the constraints for this setup is it needs to gap up above $68. And then after it gaps up above $68, when it opens, I need it to come down. I need it to come down into either 67, 66, 67, or bounce on 68. This zone here becomes my entry zone for a potential validation. And how am I going to know if there is a valid entry? Well, this is on the daily chart right now. But what you will do is you will go into a smaller time frame, such as the 4 hour, 1 hour, and then you'll be looking for a potential entry in this area through a reversal pattern, right? So the reversal pattern can come in many different forms. It could be just a potential pin bar setup. It could be a bullish engulfing setup. It could be a variety of different things that can show you, right? Other than that, it could also be unusual options activity, right? And if you have the gamma and delta levels, you could also look at that. What is there enough resistance for us to break through, right? So all of these things, when you put it together, will give you a better understanding of this setup now. And you will be able to execute this trade with more information and a proper plan, okay? Now, I've just talked about the long idea, but what about the short idea, right? Because you have to be prepared for both outcomes. So the important thing is, if PayPal gaps up and then rejects and comes back down, then I'll be looking for a continued break and rejection of the $66 level, right? Around here. So this $66 level around this area becomes a key pivot point for the bearish pivot, okay? And the bearish pivot, now you understand why for the initial setup here, I'm not taking it on the breakout. You realize that, right? What is the reason I'm not taking it on the breakout? Because if you take it on the breakout, there's a chance that you have a fake out. So you need to wait for the pullback to validate that the demand is indeed higher. Does everybody understand what I'm saying? So let me give you the two scenarios, right? First scenario. Let me mute. So first scenario, PayPal breaks up, gaps up, right? So gaps up, and then comes down to retest our 66, 67. I'm going to put it at 66 here, just to be fair, right? And then makes a run for it, right? This would be your first scenario. This is a bullish scenario, so I'm going to change it to green. Okay. That's your first scenario, right? And obviously this one might take a while to play out, right? So as a swing trader, you have to be patient. Second scenario, PayPal opens up here, it gaps up, but then immediately pulls back and then starts rejecting the 66 level, right? This falls under your bearish scenario, right? So obviously I'm oversimplifying it with the wave structure here, but you guys kind of understand what I'm talking about. The reason why you wait for a pullback after the breakout is so you can ensure two things. Number one, that liquidity gets a reset. Number two, that the fact that you don't get faked out. Okay, this is a very important part of observing setups. Okay, so when you look at this setup, that's how you need to be prepared here. Now, obviously, after this comes your preparation for the options trade, where you have to go look at the option chain, yada yada, select the right contracts once you're ready to execute. So there is a multiple setup process to this. But building consistency is all about getting these setups carefully drilled down. That means, what am I really looking for this setup to work? And you note down exactly what that setup is. So for example, you have a breakaway opener here. Next, I have another setup. What is this one called? It's called a liquidity breaker, right? This was a bullish setup, bias bullish setup, but this is a bearish bias setup. What is a liquidity breaker? This must be a stock approaching a key pivot or a liquidity on a higher time frame, right? And then you ask yourself again, where are the indices? Where are the dollars? Do we have confluence with the indices? Do we have confluence with macro opportunities, right? And then the chosen setup has to break the key pivot point and sharply move in the opposite direction, right? Closing above or below pivot. Do you know what did this recently? Does anybody know which ticker did this recently? It was Tesla, right? This was Tesla. Look at it. This is what I call a liquidity breaker. Okay, so look at Tesla here. What did it do? Look at the 1 hour chart if you can't see it properly, right? This was your key. Sorry, let me turn off this. This is gonna mess with you guys. What happened here? This was a key level, right? This was a key level. Everybody was watching the 182 level, right? Last week. And everybody was chasing this to the upside, because everybody saw that this was a low that got put in and then another potential low. And I think what everybody was focusing on was this kind of inverse head and shoulder pattern. And in the end, what happened, right? We had Tesla go up, draw on liquidity. And what did it do? It pulled everyone down, right? So these are the kinds of setups that you need to be prepared to take. So this is I'm giving you another setup here, right? So you need to come up with your own. You need to come up with the ones that you are comfortable with, the ones that you truly like and enjoy trading. These are a few that I like, because for example, with this setup here, the liquidity breaker, why do I like this setup? It's almost instant. It's almost instant because when you see the rejection, and obviously here, right, on the 1 hour, it was clear as day that was going to be a reversal. Now, did I take this setup? I didn't. But upon hindsight, I'm giving you this information because it will apply to a lot of different strategies, right? And when you see the draw on liquidity and then a rejection and continued move down, then you have one of two ways to play this. You can play the intraday setup, which is the short into the day, or you can be a little bit more patient, which is what I intended to do, right? And then wait for another run up. Because I have a bearish bias on this trade now, what's happening here is my current entry angle for this trade would be that I know that there is a gap here, right? And everybody's gonna be looking to fill the gap, right? Everybody's gonna be thinking that, oh, it's gonna fill the gap, it's gonna fill the gap. What I want is instead Tesla to go up and retest one of these levels, right? And then come back down. That's what I want, right? And that would be my entry for the short position. But I need a very important thing to confluate from this. I need weakness within the NASDAQ, which we haven't quite seen, right? So you need to be very, very clear on how these setups work together. It's not that simple as you think. So that's your bearish kind of angle for this, right? We have a bearish bias on the setup, but we need bearish confirmation, right? So we don't have that just yet. Now, once again, once you've come up with the bearish one, you need to also focus on the bullish outcome, right? So how does this setup invalidate? Remember, why am I doing this? This goes back to day 2. What are we trying to avoid here? Can somebody tell me? What are we trying to avoid? Which bias are we trying to avoid by coming up with both scenarios? Exactly, confirmation bias, right? So what are we doing here? Instead of just taking our gospel truth to be the one setup that we have outlined, we're looking at both angles so that we don't fall into confirmation bias. And so by looking at both angles, now you're like, okay, I know how my plan is going to work. I'm not going to deviate from it, right? So my initial plan with Tesla is a bearish entry. In order for a bearish entry, I need a bullish wave up in order to enter my bearish entry. For those of you that don't know these basics, I have to probably say it out loud very directly. If you are entering a bearish trade on a bearish wave, you are overpaying for your trade. It's not a good idea most of the time. That's the reason why we say don't chase trades down, because what happens is a bunch of people will join the trade on the wave down, make it more expensive as the price is coming down. And when you pay those prices and the stock rebounds back up, then you're caught in what do you call a drawdown, right? And the drawdowns cause you to feel all kinds of emotional mess ups in your head, and then you start doubting yourself. When you start doubting yourself, you get anxiety, you panic, and then you make stupid decisions. So don't get yourself into that position. What you want to do is wait for the pullback, right? So here, my bias would be wait for Tesla to pull back, right? Into any one of these points. It could be here, it could be here, it could be here, right? Wherever I see a rejection again, that's where I will take my next bearish entry. The bullish one, how does that go? Well, it had to completely invalidate my setup now, right? That means that if I want to take a bullish trade on Tesla, this has to move higher and make another high and make another high, and then validate 182 as a potential base now. Once 182 becomes a base, I can play the upside, because then I have a confirmation that this is putting in a higher low structure consecutively, right? So it's very important to analyze things from the exploded view, go down into the smaller time frame, look at your particular entry, and then go back out into the medium time frame again to look at everything again. So to build consistency, this is what is required. You need to be able to see things from both angles, and you need to have a list of setups that you are ready and you're comfortable to take. Okay. Now, I have an exercise for all of us to do together. So I have another setup. Okay. It's called the ER run-up. Okay. And this is a very nice setup to play. Now, this is the wrong time in the quarter to play it, but it's all in 1 to 2 weeks from now, it will be the right time to play this. So some of my playbook trade ideas are also based on the time of the year, right? For example, earnings reports come up 4 times a year, right? You have a really nice window before earnings close and open, about a 2-week window, to find setups on tickers that are tickers on strong or weak stocks that might run up or run down before earnings. Okay, because remember, as I said yesterday, the market doesn't price things in when it happens. It prices in before it happens. So if the market is expecting, for example, Nvidia to blow out earnings again next quarter, what's going to happen? The market is going to start bidding up Nvidia before earnings. It's not going to wait for earnings and then play. When the news breaks, people are going to take profits, or volatility is going to just demolish, right? So for an ER run-up, what do you think the requirements are? Does somebody want to give a couple of inputs on this? If you were thinking about a stock that's running up towards ER, what do you think you would be thinking of your requirements for it? Throw down some answers. Listen, you don't engage, you don't put in the work into this, you're not going to be able to do this process on your own. I'm giving you an opportunity now to test out your own mindset, right? You need to test out what you think would be the right answer here, so that when you're doing this exercise on your own, you can do it on your own. So this is a test example, right? So Hujun says, has to be above key pivot point level in pre-market, similar to first strategy. I don't think so. No, these two are more day trading strategies, right? I specifically gave these as day trading strategies. The ER run-up is going to be a swing trade strategy, right? Support and resistance, okay, yes, but what about support and resistance? Higher highs, higher lows, okay. Outlook from previous earnings were good, okay, potentially. Any other inputs? Just put them down. It doesn't matter if they're right or wrong. I want to read all of them so that we know. I'll give you guys about 1 minute to think about it. It's moving down prior. Okay, no, that doesn't say anything. Okay, options flow. Now we're getting somewhere. So I like options flow so far. That's a good one, right? High beta and volatility. Maybe. Volatility could be one of them, but not really. In fact, you actually, before ER run-up, what you want is low volatility. That's what you want. Because the speculation towards ER will make it high volatility. High volume, potentially, right? Potentially. Okay, so far, I like one of the responses. Let's go with that first, right? You want to be looking for speculative options plays, right? Unusual options activity. That's one of them, okay? The next one that I will tell you guys, when the earnings is about to happen, you want to be looking that this stock is breaking out of a key pivot, right? So I'm going to give you an example of one that, once again, I didn't take this, but we hit it, like it was a really good one, and I fudged it and didn't take it. It is Domino's Pizza. Okay. DPZ. Look at this. Earnings is 29th April. Okay, that means it's a couple of weeks away. Now, first of all, some requirements, right? What do you need on the requirements? For earnings, you need to be able to play this you need the play to work at least 1 month before. Okay, in order to accurately capture, you need to play it 1 month before. Okay, and when I'm saying 1 month before, that means that you need to be able to see that this stock is not moved 1 month before the earnings. If the stock has already moved 1 month before the earnings, it's no longer a valid setup. So this falls under requirements. What are requirements? The requirements are some things that you can use to validate for sure. It has to be a list of rules, right? So Andrew says golden pocket and uptick in dark pool activity. I love uptick in dark pool activity, and golden pocket's a nice one too because that's a technical structure, right? So I like both of those as well, right? So you can do dark pool activity, right? Dark pool plus 61.8 validation, right? What we did yesterday with looking for longer term than shorter term, look for trend. Yes, trend is a good one, right? That's a very basic and good one. I like that, right? Trend. We want trending, right? Or about to break out into trend. Okay, that's a good one. When you say it hasn't moved, you mean it's been consolidating for a past month. I mean, what I mean to say is it hasn't moved in terms like this, right? Yes, consolidation. This is what I mean by as a move. You see, this through the earnings period to the next earnings period, it's been consolidating, right? And then just a couple of weeks before earnings, look at what's happening. It's already running up, right? There was obviously some news. It also paid dividends, right? What was the news on this? Let's go. Why is dominance user up? Let's see. The analysts, right? It's just analyst discussions. Okay, so it doesn't really matter. So for a earnings play, you need a variety of different things. You need, first of all, this thing should be in a consolidation phase. Okay, consolidation, it needs to be 1 month out from the earnings at least. 2 weeks is not enough. I've seen it happen many times that 2 weeks is not enough. You need more than 2 weeks. You need at least a month. So if you're buying the options trade, you need to take at least a month out, right? And then you need to see unusual options activity. That's a really good one. Dark pool is also really great, right? If you see unusual dark pool buying on the stock, and the reason why dark pool is more important than regular old volume, right, is because dark pool is hidden sometimes. It's on another exchange altogether that you can't see. So when it comes in through a dark pool, you're like, okay, I need to track this, right? So you have tools to do this nowadays, and you can look at that activity, right? Even the stock pot pulls up all that activity for you, and it needs to be trending, right? So you can see here that in this specific case, if we had taken this trade, it would have played out, right? But what I'm going to do is in the next 1 to 2 weeks after this earnings season is up, right? I think the earnings season is up maybe next week, potentially, right? Because, oh, maybe it's already up. Yeah, it might be up now. So the first quarter is over. You will have about a week or two, and then the next earnings season starts again. And usually a good way to know when the earnings season starts is you look at financials, right? So look at your banks, right? So 16th April, you see that? So exactly 2 weeks from now, you will have earnings. Now that I've mentioned that, have a look at Morgan Stanley, right? Have a look at Morgan Stanley. Where are we? We are at a key pivot, right? This is a key pivot right here. Yes, you can see that. Very clear pivot. And then you have another level of confluence, or you have another level of resistance / support around here. This, I wouldn't really count that much of a resistance support level, right? And this has the capability to run up till earnings, right? So now you have 2 weeks till earnings, and you have a decision to make here, okay? So what are we going to be looking for in the next 1 week? We are going to be looking for unusual options trades on Morgan Stanley, right? This is I'm giving you guys a free setup here that might be working in the next 1 to 2 weeks. So if it plays out, I will give you guys updates, right? And I'll tell you guys, right? So there you go. So Andrew also said Gamma's at 95. So you have your key level here is gonna be this pivot here is gonna be the defining factor whether Morgan Stanley starts to rally or starts to reject at this level, right? So we want to just like a bug in the face or something. Keeps flying in front of me, like, sorry. We want to now start to think about how we're going to play this earnings report, right? Now, many of you are going to start thinking, oh, I know your first thought. Your first thought is Morgan Stanley is going to beat earnings. Or your other thought is Morgan Stanley is going to have a bad earnings. And my response to this is, it doesn't matter. It doesn't matter whether they crush or they fail their earnings. Your job is not to predict that right now. Your job is only to come up with a trading plan that will allow you to profit in whichever manner it moves. That is it. Okay, you guys get very caught up on being right when the focus is not about being right, it's about being prepared, right? So here it's not about whether it's going to go up or down, it's about being prepared for both up and down. Okay, and how are we going to do that? So very simply, if we break above 95 and we can go for a deep run at the $99 level, then what I would do is go for the 95 strike or the 96 strike, if that's a little bit of option trade. I haven't looked at it yet, right? And if we can get that as the available strike that we want to go for, then we will take it for the time till 1 week before earnings, or maybe after earnings also. You could do that, right? Depending. Now, the thing is, we have to be worried about one specific thing, which is when we look at the options chain, if the implied volatility of the options chain is above 80%, we cannot take this trade anymore. If you want to take the trade, you cannot take a naked option against this setup. What will happen is that you will be susceptible to IV crush. You don't want that. Okay. So how do you negate that? How do you avoid that? You have to play a strategy, option strategy that will allow you to sell options against your bought options. So you'll either go for a debit spread or you will go for a credit spread. Okay, so it's either one of those two things where you're using two option combinations to put together in order to save yourself some money and then capitalize on the volatility that is high. If the volatility is not high and the IV is sitting around 50%, 40%, we can enter the trade and take a naked option on it. Right? I mean, either buy one call or puts. Okay. So this is just the small requirements that I like to kind of put in front of you guys so that you can understand that there are specific playbooks, right, that you can go for. There are specific setups. So in this specific setup, you need something that is trending. Morgan Stanley is trending to the upside here. If it was trending to the downside, it's the same thing, right? And you want a key pivot point where it can break, where it can show some resemblance of overnight consensus changing. Then over this 1 week, we want to look at where the dealer data is. We want to look at where the unusual options activity is, right? And then we'll get a good idea. Right, so this idea will be developing. I'll give you guys more insight when it starts developing, and you'll hear from me when I have more information on this. But I wanted to put this in front of you because earnings is coming up, right? And you have a 2-week window now to find these setups, especially for setups that are happening a month away. That means the end of April, right? You need to look at these things now because there are a lot of stocks that will be running up into earnings, and that are some of the nicest moves that happen once a quarter. Okay, it's an opportunistic moment for the markets when that's happening. Yes, there might be some that will be moving sideways and yada yada, but it's worth it to take some of these trades because they offer very high risk to reward ratios. Okay, so that's a very quick example of some ideas to build consistency. The more of these you have, right, these setups, the ones that you put together, the better your consistencies are going to get. You will have a higher success rate because you have a checklist of things you're looking for, and that'll just be easier for you to tackle. Okay, now, what about your pre-market and intraday habits? There are some simple things that I feel like traders overlook, which I mentioned before, and I feel like it's so basic, but people overlook it all the time. First thing, you sit at your trading desk, and if you're just like frantic and your energy is all over the place, you're really gonna feel very emotionally charged. As I mentioned during yesterday's session, sometimes things are not within your control. You need to understand that. I said it yesterday. You wake up, your husband or your wife tells you something out of pocket, your mood's going to be screwed up the entire morning, and you're not going to be able to see things straight, right? It happens. I mean, I had moments like that before, so I'm sharing with you. It's the harsh reality, but it's true, right? When you sit at your desk, seriously take a moment to yourself, breathe, have a breathing exercise that you like doing. It could be simple ones. Let me give you the most basic one. It's 6 seconds in and 3 seconds out. 6 seconds breathe in, 3 seconds breathe out. Do this about 5 times. You will realize all your chatter in your mind will go away, right? You'll feel calmer, you'll feel more grounded. Okay, now I'm ready to kind of work through my session, right? Make it a kind of a calming process. Don't make it like a frantic, like I'm ready to fuck shit up process. Because the more you give into your emotions that way, what's gonna happen is you're heightening your senses. You heighten your senses, you heighten your emotions. You heighten your emotions, then what's going to happen, right? So you have to calm your mind down. Calm the chatter in your head. I know you get a lot of excitement getting to do this process, right? But if you know how to meditate, do meditation. The most basic meditations, you can find YouTube videos on it and do along with it. And some of them you can even find for 5 minutes. They're simple ones. Start with those. Then sorry. Now, next thing, eat something. For heaven's sake, never trade on an empty stomach. If you're a sort of person that just wakes up and then starts trading, you are not setting yourself up for success. Let me explain to you why. It's all neuroscience, right? What does your brain use in order to process? Your brain uses the quickest form of energy, which is glucose. Okay? You don't believe me? Research it. How do I know? I studied it, right? Your brain uses glucose very quickly in your processing. So if you don't eat something with carbs, you don't eat something with protein, you don't eat something with fat, a balanced diet, for example, have a piece of toast, whatever it is. I don't know what you guys like to eat, but eat something, right? Eat something because that is going to digest in your body and it will allow you to even think better. You don't have energy and you're sitting there like a log the entire morning, like, what am I doing here? You're going to feel sluggish. If you're not feeling your best, just don't trade, right? It's pointless. You're going to put your effort into something with what, 30% effort? Might as well don't do it, right? This game doesn't allow you to put in 50% effort, guys. You put in 100% or nothing. It's simple as that. Because you are up against computers, you're up against the best minds in the world. And if you think that you're gonna get to that level by not having absolute perfection and or at least striving to work towards it, it's gonna be very difficult. Okay, so eat something. It's gonna help you. It will process your thoughts quicker. Okay, you have energy, you can think, right? Other thing, short workout or just walk around for 10 minutes. I don't care what you have to do, whether it's walking to the kitchen to get your coffee or walking up and down from your kitchen a couple of times, but walk, do something, an action. I don't know, you could be literally sitting on your desk, have your water bottle and do this. Do this for 10 minutes. I don't care what you have to do, but move. Because without movement, what's going to happen is you're going to once again feel sluggish. You need to get your blood pumping. So when you've eaten something, you're moving, your brain is thinking more clearly. What you should hope to achieve is a flow state. Have you guys heard of a flow state before? A flow state is where your thoughts are moving through your head with very little resistance. Everything is flowing nicely, okay? And when you get into this flow state, what happens is your natural level of interpretation will start to increase. You will start to see synergy of ideas, and you will start to see that you will have a better flow of thoughts, and your emotions will be in better cadence. This is something you have to understand, okay? And the last one, if you can, and this is for people who are already doing these three. The last one, if you want to really go above and beyond from everybody else, is to journal your thoughts. Journal your plan. Write it down. Because yes, we live in 2024 and I get it, everything is on the internet and everything is all electronic. But putting a paper to a pen allows you to, first of all, put your reality into perspective, okay? It allows you to look at your thoughts from a third-person objective, okay? And it will allow you to reflect in the future on whether those thoughts were valid or invalid. The idea of sharing the thoughts are so that you are lowering your ego, okay? You're sharing a piece of yourself with this piece of paper, and it's now a part of history. These four things are really important as a pre-market intraday habit. If you want to improve your trading career, I suggest you make some of these at least a part of it. Okay, I'm not going to spend much more time with it. That's all I have to say about this. So far, is everybody good? You guys understand everything? If you can, just give me a quick thumbs up so that I know everybody's okay. Good. All right. Cool. Okay. So next up, the part of the discussion is going to be market phases and trend validation. And I know you guys have seen this chart 100 million times. This is the Wyckoff cycle. For those of you that are not familiar, there's a guy named, what's his name? James Wyckoff? I think his first name might be James or something. Anyway, he came up with the study of how the market shifts in phases, okay? And there are typically 4 phases in the market that will allow you to validate the trend of the market. Okay, there's an accumulation phase, there is a uptrend / markup phase, there's a distribution phase, and there's a downtrend / markdown phase. Now, these phases, they are typically occurring concurrently in various different time frames. Sometimes what happens is you can't tell the difference between an accumulation phase and a distribution phase, because after an accumulation phase, you get a markup, but then after a distribution phase, you get a markdown or a markup sometimes, right? If a stock has very strong secular trend, like for example, AI right now is a secular trend, then the downtrend or markdown phase takes a very long time, right? In fact, the markdown phase takes months and months and months before you see a markdown, right? So my main purpose of sharing this with you is for you to understand the general idea of where institutions and how institutions position themselves. I want you to ignore the phases in general here, but I want you to understand from a perspective of an institution how they are focusing on accumulating and distributing positions. So I'm going on a very macro time frame here, which is the weekly time frame, and let's look at one of the most disgusting markdown phases that has ever happened, right? Which is PayPal, right? And obviously you have a pretty deep, accumulation phase, and then you had a markup phase, and then you had a kind of distribution phase that was up here, which was very volatile, right? The distribution phase is a big range. And then you had ultimately a markdown phase. And now it's getting prepared for a potential other accumulation or another markup phase, right? And we are watching this one pretty closely because I like the idea. The stock is not dead. It's not a bad company. It's just the stock is being discounted for various reasons, right? But I want you to understand how institutions set up the plays, right? It's not just so straightforward as you think, because when an institution is entering into a accumulation phase, and let's just call this the accumulation phase, for example, right? I might not be right or whatever it is, but I just want you to understand the principle, the logic behind this, right? The theology behind it. When an institution is accumulating positions, what is the first move that they play? They play two moves, but in the derivative market. Now, I know you might be confused for a second. You're like, what? What do you mean? Why are they taking place in the derivative market? Well, think about it logically. If they were to go and buy the equity, wouldn't they lose out on the gains of the derivatives? Because remember that there is a very important part about the link between equities and derivatives. When you're trading options, the options doesn't make the equity price jump. In certain cases, yes, there's gamma squeezes and stuff like that. But from the most basic perspective, the option price is dependent on the stock price, not the other way around. Remember that. As an options trader, you need to understand that the power doesn't come from the options trader. The power comes from the holder of the shares of that specific ticker. Everybody understand this? This is a very simple principle, right? So now if you understand this, then you need to understand that if an institution is going to make a move, the first move that is made is always by purchasing calls. If it's bullish, okay? They will purchase calls and they will sell puts. They will sell puts in the downtrend and they will buy calls in that same downtrend because those are the cheapest positions, right? Now, after they have set this position up, the puts will expire worthless. They will earn money from here. And the calls will be riding. This is typically done in separate transactions because what will happen is they will always sideline equity together with the trade. So along with the calls, what they will do is they will start to purchase equity. That's when you start to see the prices move up. That's the start of your markup phase. Now, when markup happens, the price of the option goes up, the put contracts expire worthless, the equity goes up, they have a triple net gain because they have gain from the sold puts, which expire worthless, they have the gain from the net calls, which they have purchased, and they have capital gains on the equity. That's how institutions play the game. When you're a wholesaler, I'm talking about institutional. When I'm saying institution, I mean players that are huge, people with $1 trillion in AUM, right? As the trade starts moving up, what happens? Retail traders start getting wind, right? Professional traders also start looking at it, right? That's when we come in, right? We provide, as retail traders and professional traders, okay, professional traders are a bit better, but as retail traders provide liquidity and most of the time exit liquidity for institutions. That means the move has already been made, and this is where retail is trying to take a punt. They're trying to speculate up here. And in this position here, there is a chance that it will move further higher, but what institutions will focus on up here is they will sell you calls and they will buy puts. And then they don't sell the equity yet. They hold on to the equity. They hold on to the equity until a maximum pain point is realized. Until no more value can be drawn from the derivatives, they will continue selling calls, continue selling calls, continue selling calls, continue buying puts. And when that is completed, that is when the markdown sequence is initiated. And it takes a few block trades for this to happen, but then when the fall happens, it happens quickly. And they're already set up for that, right? As the prices come down, the whole cycle repeats itself. Okay. Now, this is just a general idea of how institutions play the game. And you realize that institutions are taking the exact opposite trade of what you are taking. This is the reason why sometimes the odds are stacked against you in some cases. I'm not saying that it's always stacked against you because that would be very false. What I'm saying is sometimes what happens is you think that you're getting a good deal, but you're already priced out. You don't know that, right? So the most important thing for you to understand is how institutions play the game. And there's more complications to this because the way that they set up their trades, they take calendar spreads, they make it hidden so that you can't really see it. They will often take two trades with a separate expiry, and you will count it as two individual trades, but actually they're part of the same idea. When you're looking at the unusual options activity, remember the most important thing is you can never know what that person's thinking. You don't know what is the reason they're taking the trade. So you have to be extremely cautious. When you look at something and it's a one-off, very high chance that you should ignore it. If you see it coming up over and over again, repeat flow with high conviction, okay, now we can talk about it, right? There's obviously something there. Multiple people are taking it, right? So let's talk about support and resistance a little bit because we left off on this topic yesterday, and I want to cover a little bit of it in part of trend validation. Now, for most of you that know support resistance, I think some of you look at it as like just two flat lines. And yesterday I went over the idea that it's not two flat lines, it's a zone. It is a zone. You need to understand that yes, there are levels, there are specific levels, like at a point where where liquidity will come in, but it's always better to look at it as a zone, especially as a beginner. Okay, if you're just getting into this, stop trying to snipe perfect levels. It's not going to work. Look at it as a zone. It's always a big zone. You can give it a couple of dollars, right? And look at where the key levels of liquidity are, which we went through in yesterday's lesson, right? And that will give you a good idea, right? And as I mentioned yesterday, start with the top-down analysis. You need to always start with the top-down analysis. Start with weekly, daily, right? Then go through your timeframes. As you get lower, you will start to find more conviction. And always key levels are found on higher timeframes, right? Because that's where you can see the big picture. So go in from your weekly all the way to your daily to 4 hour, 1 hour, etc. Now, as I said, treat it as zones, not just lines, right? There's always zones. And remember that support and resistance are both horizontal and dynamic. They are not just flat lines sometimes. They can be sideways like this. They can be like this too, right? You can have support trend lines, right? You can have resistance trend lines, the same thing, okay? And moving averages are also used to identify key areas, right? When you have a 200 moving average, everyone knows it's a pretty strong level of support or a strong level of resistance. So keep that in mind as well. And a lot of people talk about patterns, but where do patterns come from, right? You hear this all the time: ascending wedge, pennant, head and shoulders, cup and handles, yada yada. Where do these things come from? They come from the supply and demand imbalance. That's where it comes from, right? So for example, a higher low into resistance usually results in a breakout. That's what we call an ascending triangle, right? And then for this kind of a setup, you have to have validation rules, right? Where are your key pivot points? What are you looking as the rules of engagement for the setup? So let's say you really like trading ascending triangles. What should you do? Create a playbook for it. Create a defined set of rules that you need to do in order to succeed in the setup. You see where I'm going with this? I'm trying to put everything together now for you guys, right? So if you really like this setup, focus on the setup and note down what are the clear levels in which you need to achieve the setup. The same thing goes for a descending triangle, for example, right? Why does a descending triangle occur? Because its lower highs into a support. And this usually results in a breakdown, right? You can see the highs get lower, but then the bottom stays flat. That's why it shows price actions weakening, right? And here price action is improving, right? Remember, this is different from a ascending wedge pattern. See, the difference between this and this, sorry, wrong drawing on the second one here. I meant to draw something else there. So the difference between this and having something where it's ascending like this, and then also ascending like this, right? You can see one is pointing upwards and one is flat. It's kind of flat on the top, right? There's a difference here. The difference is this is price action that's moving higher while sellers are defending, right? But here, there's no defense. It's just price action going up and up and up and up and up, right? Higher and higher. This setup, which is an ascending wedge, is actually a bearish setup. This is a bearish setup. The same thing goes for the descending triangle. There is a descending wedge setup. You guys have seen those before, right? They go kind of something like I want to say something like this, right? That's a descending wedge, right? When they start to buy equity, are those the dark pool prints? Yes, there can be the dark pool prints. That's one of the methods. Other times you can also see through unusual options where they're going to start to post positions. You are in large block trades, 9% dark pool. Yes, correct. I have a visual. Let me see if I can find it. Yeah. How do you avoid getting faked out for a double top or double bottom? Well, you simply don't take the breakout. That's how you avoid the fake out, right? I mentioned this earlier. When you're looking at a double top or double bottom scenario, you need to wait for the key resistance to be validated. That's how you avoid it, right? Let's say you have your double top, double bottom scenario. Let's do double bottom first, right? Sorry, straight line on this thing. So let's say this is your key pivot, right? And you've observed that it's a double bottom. Then if it breaks out here, you're saying, how do you avoid to get faked out here, right? You're saying, how do you avoid to get faked out here? Yes, George? Yes, right? Well, wait for the breakout and then the validation of the breakout, right? You need to see bounce here. Because if not, what happens? If not, you get a scenario in which the breakout happens and then you get trapped, right? Like this. So you have to wait for the breakout and wait for the validation of the breakout. Higher time frame is key here. Give it more time. Whatever time you think, yes, wait for a pullback. Always wait for a pullback. Always. Because it gives you a better entry anyway, right? Like, if you play the breakout, yes, you might make a little bit of money. And I told yesterday we discussed this, right? What I said yesterday, you can play the breakout. It's not wrong. The problem is many of you don't take profits. That's the problem, right? You play the breakout and then you're like, no, it's gonna keep running. Let's go. And then it keeps going, goes a little bit higher. And then you're like, you know what? This might run. It might gap up tomorrow. You know what? I'm just gonna swing this trade. Wake up, boom, down back into the fake out, right? That's what happens, you guys, because you don't take profits. So how do you avoid that? Create rules that will disallow you from making these mistakes. What I'm trying to teach you here is to create rules so that you don't mess up. Because you have to be aware your brain's going to play tricks on you. I told you this yesterday. How many things do you have working against you, right? Now, another thing. Avoid placing stop losses right at the support and resistance. Come on, I think it's 2024. We all know this by now, right? Y'all ain't rookies anymore, right? And when I say don't place it as support resistance, that means don't be smart about it, right? Be smart. If you know that this is a point at which a market maker is likely to retest, then you need to either have the right entry or you need to have the balls to hold through the position. Let me give you another pain point here that traders experience. Okay, I'm going to show you. Okay, so I'm going to talk about Tesla here on the 1 hour chart. Okay, so let's say you wanted to go long on Tesla and you have actually accurately figured out that this is the level which I want to take my long position. Okay, this is all hypothetical. I'm trying to prove a point about stop losses here. Okay, now if you went long here and you had an instance to take profits and you didn't take profits, or you botched your entry, in other words, you entered wrongly. Okay, and when I say entered wrongly, what does that mean? Maybe you entered on this breakout here. Okay, you entered on this breakout here and you played this breakout right here, right? Now, because you entered wrongly, what does that mean? Your stop loss is going to be at the low of this part here, right? Probably. In order for you to invalidate your setup here, you probably choose the range, which is at the bottom of the candlestick, and you probably look for that as your defining criteria for you to get stopped out of the trade. Right or wrong? Does everybody follow me so far? Or do you need me to drill into a smaller time frame? Maybe I'll drill into a smaller time frame. It's easier for you guys to understand. Okay, so let's look at this in a smaller time frame. 15-minute time frame now. Okay. You saw Tesla come down, it gapped down, you saw a quick buy up here. You didn't enter here. You decided to wait. It came back up, it came back down, it came back up. And then you said, you know what, there's a previous level here, there's a high here, there's a gap to be filled here. I want to play this on the break of this. Okay. What happens here? Okay. You took the breakout, you played it up. And let's assume here that in order to invalidate this trade, what did you say? You said to yourself that the stop loss is at the bottom of this range, right? So if Tesla breaks below this, then I'm going to cut the trade, right? This is a standard, like I feel like this is a lot of ways in how retail traders would position themselves, sometimes on the breakouts, right? So I'm going off what George is saying to prove a point about stop losses. The issue here is not the stop loss management. The issue here is not the stop loss management. What is the issue? The issue is you shouldn't even be in this trade right now. Right? Because the trade entry is so bad that you have barely any risk to reward ratio here. Right? Even if you took this as your resistance and you were expecting a huge move from here to here, right? You're taking on all this risk here, all the way down here, right? From a swing trading perspective, this is a terrible trade. If you're looking at a day trade perspective and you forgot to take your stop losses, you get clapped automatically, right? So my point that I'm trying to make is, because you guys choose very predictable levels for your stop loss sometimes, and then you botch your entries, it's a double whammy. It's like you can't win. How? How can you win? Either your entry has to be right, or your stop loss has to be far enough for you to not get a botched entry. So you have to really observe these two things, because it makes or breaks your trade. Wrong entry gives you a wrong setup. Wrong setup gives you wrong stop loss. Wrong stop loss means you get stopped out without you realizing that that was a wrong entry to begin with. So the right entry is the most important factor, because you have the right entry, you have the right framing, you have the right stop loss. A lot of your problems are conquered if you use the right techniques. Okay? If you don't know, ask. Ask someone to validate your trade idea. It's never wrong. Now you have a community of over 400 people that are willing to answer your questions. But yet, some of you decide to do things in silence. Yet, be in your own world in a silo. Why? You have the resources. You have me. You have Andrew. You have so many different people who you can go to ask questions. But yet, this doesn't help you, right? Ask questions. You will learn, right? Ask us, hey, I'm planning to enter this spot, What do you think? Right? We'll give you our opinions. We'll tell you. We have been in this game for a while, right? Okay, that's my point about stop losses. You get a wrong entry, you get a wrong stop loss. You get a wrong stop loss, you get stopped out. You get stopped out, you start asking yourself, why did that happen to you? Why does God hate me? And then at that moment, you just go down an emotional spiral, which is not fun, right? So don't put yourself through that. Next up, dual zones. This is a term that has been very popularized since EGA started, and I'm going to continue on the tradition of sharing with you guys. A dual zone is a zone in which both support and resistances occur, so both supply and demand. These are zones in which role reversals occur. That means bulls might take the role of a bear and bears might take the role of a bull. Trading within this zone can be very choppy. Please avoid it. If you see a zone is a dual zone, what is a dual zone? This is a dual zone. You have a bunch of support. This is a big time frame, right? One daily. On this is XLF, by the way, right? Not long ago, by the way. If you see a bunch of supports that occurred in this region, and then now it's turned into resistance, this whole zone is a choppy zone. You have to avoid it at all costs. Because what will happen here, you will just have a bunch of fake outs. You will have up and downs, ranges. It will not be a tradable zone. Okay. Very simple idea, and you all should be aware of this. These zones are very nightmarish for traders to get over. Now, they happen more often than you think. If you look on a bigger time frame, you'll find them, right? They are almost everywhere, right? Look at Tesla. There is one right here. I don't know if you can see it, but there is one right here that is potentially forming, right? A dual zone. Why is it a dual zone? Because in the past, it has acted as support, right? And then it became a weird resistance scenario here with the support, right? And then it became a resistance here, a support here, right? This whole zone here is a choppy zone. So whenever Tesla is moving to this zone, you better be out of your trades when you enter that. It's like the eye of the storm. Because there's going to be a lot of buying and selling here where you will not be able to get an accurate prediction on where price action is heading. And when you don't have that, simply don't trade, wait it out, right? You need to have directional bias to some degree and be prepared for both outcomes. But when you have no directional bias and then you don't have an outcome, you're headless, right? It's pointless to trade that. So avoid dual zones at all costs. It's a very simple idea, and it will save you a lot of headache. Next is going to be the two-wave confirmation. This is another signature move that we have kind of, I guess, over the years uncovered. It's something that I form as a setup for a swing trade. Okay, what does that look like? It's typically after a stock has bottomed. So PayPal would be ideal for this one, right? And obviously we looked at this on the 4-hour chart earlier, right? Typically, what will happen is you will see a stock would have gone through a big decimation, sideways winding position, blah, 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 blah. And then now it might be ready to pull out of its downtrend, okay? And I know, oh wait, PayPal, not yet. It needs to break this level here. This is the key pivot. So what you want to see is a two-wave confirmation from the previous break of structure. So for example, here, the most recent resistance was here, right? The previous resistance prior to that was here, right? And PayPal trying to break out of this previous resistance area here, which will set it up for its first wave. Once it pulls back, this is wave number 1. You will not enter. You will ignore it. Because when it pulls back, there is a likelihood that your two-wave confirmation will be invalidated. That's why you avoid the first wave. Okay, this is a safeguard strategy. Then, when you get the second wave, you now have confirmation that you are indeed in a longer-term uptrend. That's when you can enter if you validate the previous level as a support. This is only after it breaks above the previous trend structure. So it needs to break the structure, the long-term structure. Okay. And this will give you your actual entry on the pullback. I'm giving an example here. It's not going to play out like that, but yeah, I'm oversimplifying the idea, right? But I just wanted to give you like a visual of what it looks like. There might be other stocks that are bothering it too. I think there's Roku, right? This one's kind of being a little bit of a shit show right now, right? It's a big megaphone pattern that's looking weird. Now, same thing here. You have this level, huge level here. You have past resistances here, here. So this is not really a good one to play the two-wave setup, but here you might have a potential bounce and then validation for upside. But I wouldn't take it unless it has formed a proper base. So for the two-wave confirmation, you need it to work on a 15-minute chart, okay? And you will see the setup. I'll post it for you guys when it happens. It happens from time to time. And it's typically best on stocks that are bottoming out or have some kind of a top put in. Actually, Microsoft is one of them. Let me just show you that real quick. So Microsoft had a rejection of its local high, right? And it needs to validate this setup in order to play out. So how does the two-wave confirmation here work? You have a range so far, right? This is your top of range. You have the bottom of range here, right? In between, you have a chop zone, right? So Microsoft needs to come down. It needs to break, come back up, come back up. That's going to take a while, obviously, but you get the idea. It has to break the structure and come back up to retest, pull back. Only upon breaking the second wave is where you can enter that trade. So now it's in wave one, it's going to continue going down, and then it'll come back for a wave two. And that's obviously if it wants to enter the bearish kind of formation. Okay, so the idea here is to validate through two waves at the minimum. And once you get that, you have a confirmed break of structure of the previous high or low. You can start to look for entries after that second wave. It'll give you a much better focus. Okay. All right. Now, so we did the checklist, we did the trend validation, we did the consistency profits. I just have stop losses to go. And yeah, I think that's about it. So for trading checklist, we build one together. Do you guys have any questions so far? Let's do a little bit of a check-in here. How's everyone doing so far? I know we've been talking for quite a while. How's the session going for you guys?
It's going good.
All right. I need to also take a sip of my coffee. So would the wave two confirmation be at 4:30 for upside? I think Hojun, I think right now for Microsoft it's too early to tell. But I wanted to put this as the bearish example so that you can just keep your eye on it for the next couple of weeks. Realistically speaking, it needs to break quite a bit of this area here. It's a lot of price action here, right? Whenever you see a block of price action like this, to me, this is just a lot of things that needs to be cut through, right? There's so much of trading psychology here, right? Okay, example of breaking structure. I have one here. I'll show you. This was in the past, but I'll show you exactly what I'm talking about. So this is back when Neo was trading at, I think maybe, oh, so December 2020. This is an example from far away. But I'm just showing you how it looks like, right? Okay. So you have a downtrend. Remember, this is a 15-minute chart, right? A downtrend that's forming. Then you have kind of a reversal pattern. What is the reversal pattern here? You have a past resistance area, right? Which was just supply that came in. It pushed Neo down. It reversed out. And what did it do? It invalidated the previous structure. You see that? It broke. It broke the structure. But after breaking the structure, it pulled back. This is how you validate the first wave of this structure. It's a reversal. Okay? But you can't enter on the reversal. Because you know why? If you enter here, what tells you that this can't just go like this and continue moving down, right? This could go down again and make a lower low and then come back up again, right? And then make a lower low again, right? This can still be a part of the down structure. So the only way you're going to validate that is by confirming that this is indeed making a higher high, higher low structure. And that is done through the second wave confirmation. The second wave confirmation would be a bounce and then another run up to invalidate the first wave high. On the pullback of the second wave is ideally where your entry should be. And honestly, this part here, anywhere could have been an entry, anywhere for a swing trade. And that gives you your 3, 4. And after, and obviously 5 after that, after this, you need to also take into account the stop loss management, right? So if you're entering in this area here, right, your stop loss has to be way down here, right? Because you cannot use this as your stop loss. Market maker can easily come down and draw on this liquidity. You have to be aware of that. You have to take a stop loss that's way below here, right? And so if this is the risk you're taking on, your reward has to be higher, right? And that is a matter of risk to reward. So that you can adjust on your own, right? That's just position sizing, okay? Then as the stock moves up, you take profit, you move your stop loss to break even, you know how that goes, and you move that break even up into profits. As it pulls back, you can add more, you can take profits on the first tranche, add more here, you can do all kinds of funny things. That goes down to execution, right? And that's different for everybody. Okay. But this is an example. So this was Neo really far back, but you know, I will find some examples and I'll post it in the chat for you guys, both on my Discord and Andrew's Discord, so you guys can see what it looks like. Okay. So we have stop losses to go through. Let's take a quick break for 5 minutes. While the break is about to go on, I'm going to just tell you guys about some of the changes that we've made to dedicated help to service some of the new students that have joined Timeless Finance, which is about to be Timeless Finance, which now Andrew has made me see something that I cannot unsee. I just want to kind of give a little bit of an explanation on what are some of the tools that are available for you guys. On day one, I spoke about the Discord access. We opened that up to a free access. The second day, I spoke about the course, which is something that is just a good flagship that we have for people who are more introverts, who want to learn on their own pace, right? You have that option. And the third is for people who are really going through the thick of it, but you're alone. This is specifically for people who are at level 3, looking to move into level 4 of the hero's journey. You're ready to progress on and leave your past behind. Only if you fall in this category is where I want you to reach out to me. If you're stuck in 1, 2, 3, you can reach out to me, but I have to make a judgment call on whether you're going to be a fit for the program. Because it is very difficult for me to teach you how to be disciplined. That is not something I can do. I cannot bring the horse to the water and force the horse to drink. You have to be ready to be disciplined and take life in your own control. Then only I can help you, right? So this is for people who want to fix technical issues. It might be execution issues. It might be specific knowledge gaps. I'm good at that, right? I know what I'm good at. You might have issues with psychology. I can fix that. We're doing that currently with our existing batch of students, right? Q1, we already have 6 spots filled. I only accept 8. I cannot do more than 8. I've done 15 in the past that made me go borderline crazy. I cannot manage 15 personalities at once. It's not possible. I've streamlined it down to 8 people now. I can take 8 people that I can manage per quarter. We have 2 spots open. I will dedicate those 2 to 3 spots for people in Andrew's Discord and my Discord. I'm not going to open it to public. I'm not posting it on public. I'm just opening it to you guys. That also, in order to get a spot on this, you have to go through a informational call with me. Okay? And how do you get access to that call? I'm going to just very quickly put a link to the calendar for you guys in the chat. So if you are looking for that help and you need that help, then you need to reach out to me on this link. Okay? And there will be a little bit of a questionnaire that you can fill up, which is a very simple questionnaire. It's like, this is my problem now, and what I need to discuss. You basically write an agenda, okay? And it will book you a call on my schedule, and then we can talk about how I can help you with things. The first session will come with a full psych eval. We'll go through exactly what you're good at and bad at. There will be an entire personalized trading style that we'll be developing together. And it's all going to be informationally based. You're going to keep a trading journal. Your trading journal is going to be populated. We will look at the data after a couple of weeks. We will use your data to make you better. After we make you better, we will reiterate that process and keep doing it until we find what you're good at and what you're bad at. What you're bad at, we drop. What you're good at, we double up. We then continue testing that process until you are in the zone where you find the setups that work for you. That is what this is about, okay? The deliverable for the mentorship is the checklist of all different scenarios that you need to succeed. That means every day you turn up to your desk, you have something posted in front of you. You're following that and you're iterating through that process. It's all done for you. Okay. 9 sessions. First session is free. You must complete it within a quarter. Very simple. It boils down to about a session a week, but I put an additional space for 4 weeks in case life situations happen. Maybe you are sick, maybe I'm sick, maybe we both need to go meet Andrew to eat a burrito, something like that. Okay. You guys get the point. So this is available for those that are really looking to move into that space. As I've mentioned it many times before, this year I find it very fulfilling for myself to work one-on-one with people because I see real good changes. And that's what we aim to do, right? So this is available if you need it. It's just something that will be there. I'll see you guys in 5 minutes. Take a quick break. We'll talk about stop losses, what are the right ones to use, etc. And then we're done. So I would probably give this a maximum about 15 minutes more with the 5-minute break. So 10 minutes to discover to talk about stop losses, 5 minutes, and then we wrap up the boot camp and we are on our way. All right. So see you guys in about 5 minutes. Alrighty. So after this session is over, we'll all be porting over into Andrew's link for Zoom to do the weekly prep. So here's the link for the Zoom that will be coming up. Are we ready to get into the final portion of the bootcamp? Is everyone here? Okay, let's get this started. So stop losses. There are two basic stop losses, first of all. The first is called a buy stop order, and the second is called a sell stop order. This is the most basic ones. What is the difference between these two? One is protecting profits of a long position, right? And the second, what does it do? It's basically an order that converts to a market order at a specific stop level. So let's say you have a setup that you're trying to validate. This is your key pivot point, and you know that if it goes below this point, right, then you want to exit the trade. Well, you can put a buy stop order here. What will happen? It will close out your trade and it will protect your profits if the trade moves in the opposite direction. The thing about this order is it is a market order. So what happens? You will fill at the best available price which the broker gives you. Okay. The second is a sell stop order. This protects your profits of a short position. It's the inverse of what we were just talking about, right? And if you have a short position here, this order protects your short order and it will stop you out from incurring more losses if the trade runs against you, right? So the same thing happens here, a market order, and it will stop at the best available price. Now, you shouldn't use this until and unless it is a very high volatility environment. These order types are for when you don't care what prices you get filled at. This is a very important thing that you need to be aware of because it is very different from what we call a stop limit order or a trail limit order. Okay, a trail stop limit is what it's called, right? What does a limit order do? It protects profits of both a long or short position, very similar, except for this has a limit component. What does a limit component mean? A limit component means that you specify the price at which you get filled at. Okay, this is an important assertion. Because if you give the market maker the power to decide what price you're exiting at, it will fill you at the worst possible price. But if you put in a limit order and you set the price, the market maker has no choice but to go out in the market and find an order to fill you at that price. Okay. Now, one thing about limit orders is there is no guarantee that you'll be filled at your limit price. Sometimes when the tape is very, very volatile, what will happen is that the bid and ask spread will become either too tight or too wide. And when this happens, your limit order might not be filled at all. I'm pretty sure some of you have been through this process, right? But it still forces the broker to give you the price that you want, so it won't close you out until it gets that order. So how do you construct such a order? There are two portions to a limit order. When we call it a stop limit order, okay, there's something we call the stop price, and then there's something we call the limit price, okay? You'll see that in your broker setup. Every broker will have the same setup, okay? Doesn't matter what broker you use. So the stop price is the price at which you want the signal to be sent to your broker that prepares the broker to stop you out at the limit price. And this is typically a couple of cents above your price. If you're trading options, there is no below the price because of calls and puts, because the prices are absolute values. But what you need to do is stagger the two. So let's say your contract price is, I don't know, let's say $3, okay? And you want a 30% stop loss on this. What is 30% of $3? That's 90 cents, right? So the stop loss is 90 cents away from $3. Therefore, your stop price is $2.10. Everybody follow me so far? Because $3 minus 90 cents is $2.10. This is the price you want to get stopped out at. So your limit order is $2.10. Okay? And if your limit order is $2.10, then you need to look at what the bid and the ask price is to see what the difference is between the bid and the ask spread. If the spread is 20 cents wide, then the difference between your limit order and the stop order has to be 20 cents. So this would now be at $22.30. Okay? So understand how this goes. The price comes down when the option price hits $2.30. The signal will convert from a stop loss order into a limit order. And then you will get filled at $2.10. That is how the construction of a stop loss works. Okay. Now, what about if you are thinking of a, trail stop order, right? You guys have heard of a trailing stop. A trailing stop is where your profits, the trailing movement of the stop loss is constantly moving down and locking in profits for you. For a trail stop order, never use the regular trail stop. Always use the trail limit, because the limit price, you can define it and you can keep moving it. You can resend the trade and you can keep moving it. It's the exact same, except for you want the limit trail threshold to be between 8 to 10%. Okay? So 8 to 10% of the options price, not 8 to 10% of the equity price. Okay? So when you put in the function of a trail limit order, what happens is you want to have the trail to be set at around 8 to 10%. I personally go 10% because I'm more risk, I usually take a bit more risk. And what happens here is every time the trade moves down, it'll give you a 10% buffer. If it becomes less than a 10% buffer, it will stop you out. Okay? But if the stock continues moving down, it'll keep locking in 10%, 10%, 10%, 10% at a time. Right? So there is a difference between these two orders. Make sure that you are aware. Now, why am I putting such a big emphasis on stop losses and the way to construct stop losses? Because when your order flows through the system, you need to understand that if your broker doesn't have the inventory to sell you the order, what happens? That means, see, there are some brokers that have inventory. TD Ameritrade or Charles Schwab, for example, they're a big broker. They have inventory on hand. What does that mean? They own the shares outright at lower prices. They don't mind letting it go to you at higher prices. They take the profit, right? But when the broker, such as your own broker, doesn't have inventory, what do? They do something like what Robinhood does, which is payment for order flow, right? What is the payment for order flow process? That's when they sell your trade to another fulfillment house, okay? And that fulfillment house will pay a commission to your broker to facilitate the trade. Now, if this is a market order, what do you think is gonna happen? You're gonna lose out a ton of money because, first of all, that trade is sent to another broking house. And if that broker doesn't have inventory, it will forward to another broker. So it keeps forwarding until you get the fill. If you put a market order, it will just keep pushing that order out to fill you at whatever the best available price is. And that might sometimes result in hundreds and hundreds of dollars. I have done the calculation. Sometimes the disparity can be huge. Okay, it can be huge. So by putting in a limit order, you're forcing the broker, and when you put in a limit order, you're also conserving your stop loss in a very defined space. Okay, so be very aware of this. It's just a very important thing. Okay, so with stop losses, the general consensus. Let's say you enter any position, right? Let's say let's go back to Tesla, right? Because I think this one's one where a lot of people always look at, right? So when you're constructing a stop loss, let's say you intend to go long here, right? And you think this is a long thesis, you have a long bias, you're setting up for a long position. Let's say you put your stop loss down here, right? And this is where your entry is, and then this is a nice risk reward ratio trade, right? To the upside. From here, this is your risk, this is your reward, right? When you are orchestrating your stop loss, especially for an options position, right? For equity positions, very straightforward, right? Because you have just dollar amounts to deal with. But when you are dealing with options, you have secondary considerations. What are those? Those are the Greeks, right? Now, how do you accurately measure a stop loss based on momentum, volatility, and all those other criteria such as theta, gamma, and delta? Here's a quick rule of thumb to get you through that. And it might be a little bit confusing, so I'm going to try and go a bit slowly here, okay? Because this is the last part of this session. If your entry is here, and let's say the contract price is $5, okay? And you choose a contract that is out the money. Let's say over here, you choose a contract that is 180 calls, okay? So the 180 calls here, let's say they cost $5. I'm giving you a hypothetical scenario here into how to construct your stop loss, right? The contract costs you $5. You bought an out the money contract. That means the delta of this contract, which is the value add to the contract per dollar movement of the stock, is going to be less than 0.5. What does that mean? For every dollar that the stock moves up, your contract will theoretically gain about 0.4 or somewhere between 0.4 to 0.5 cents, right? So if, let's say your trade was orchestrated at 175, if it goes to 176, your contract now goes to 550. If it goes from 176 to 177, it goes to $6, right? And so on and so forth. You get the idea. That's how delta works, right? But it's theoretical because there are other things that are playing here as well. There's theta, there's gamma, there's vega, there's the volatility component as well, right? But how do we know what this distance is? You know in dollar terms, right? You know it in dollar terms. But how do you know in terms of the option terms? How do you know what that is in terms of the options price? Well, a good rule of thumb is to use delta as the proxy. So let's say that from here to here is what? How many dollars? $3, $2, right? Let's call it $3. That means from my entry price at 175 or 176, I'm looking at a $3 window in which I have to take a stop loss, correct? That means if my delta is 0.5, then my stop loss has to be a function of my delta, right? In this case, let's say it's 0.4, right, as a delta, because it's out the money contract that you're buying at 180 calls. Then you need to take the $3, which is your stop loss, times the amount of deltas, which is 0.4. That gives you $1.20, right? So your stop loss is actually $1.20 away in delta terms. Put this together with your expected stop loss. Okay, I'm going to repeat it because I think some of you might have missed what I said. Okay, so you have an entry here, and this contract cost you $5. What was the contract you bought? 180 calls for Tesla for the week because you're expecting a bullish move. But you need a stop loss, right? Your stop loss is $3 away from the entry price of 176. That means your stop loss is at 173. That is a $3 move. You need to look at the delta of this contract in order to figure out in what dollar terms is that in the options price. This is a very good rough gauge on how to construct your stop losses for options trade. Okay. So if the delta is 0.4, which you remember that delta ranges between 0 and 1 for all options. When you are at the money, delta is 0.5. When you're out the money, delta is less than 0.5. When you're in the money, delta is more than 0.5. These are rules that you have to remember by now, okay? If the stop loss is $3 away, $3 times the delta value, which is 0.4, will give you $1.20. That means your stop loss is going to be $5 minus $1.20, which is $3.80. Is that clear? Does everybody understand that so far? This has been my biggest challenge. I could never figure it out. Thank you. No problem. Of course. So stop loss is 380. Let's say bid ask is 0.2. So then would the stop loss be triggered at $4? Okay, so we are talking about the limit order is a completely separate thing to this first. Always remember this first, figure what your limit price is, then figure out the spread and then add the stop price for that. So figure out the stop loss limit portion first. The limit portion is 380. That's the absolute lowest you can go. Now look at the bid and ask spread. If the bid for Tesla, it's a very small spread, usually 5 cents, 10 cents, right? So you want to go risk averse, you can go 10 cents. What do? Add 10 cents to this. 390 is your stop price. This becomes your limit price. Okay, is that clear? Another example, last example, and then we'll call it a night here. Okay, and I just have some closing comments. After that, everybody can have their day gone. So let's say another example. Okay, Boeing. You took $200 calls. Your contract cost you $3, right? By the way, when you do this exercise, you will also start to realize whether the trade is a good trade risk reward ratio outcome. So this exercise is really good for you guys, right? Sorry, 1 second. This is too big of a time. You took a trade here, it costed you $3. Example. You bought $200 calls, right? That's $3. Okay. Your stop loss will only invalidate below this level, right? This is a terrible setup. First of all, risk reward ratio doesn't make sense, right? Because you're taking this risk on this risk on for this reward. It's a 1:1, so not a really good setup. But I still want to go through the process with you guys, right? So $3. Let's assume that your stop loss is how many dollars away? 192 to 186, that's $6 roughly, right? So let's say the delta of the contract once again was 0.3 in this case. 0.3 times the $6 move that you require for the risk to be taken off is 180. Right? $3 minus 180, that means your stop loss is at 120. This is your limit order. Add the bid and ask spread, another 10, 20 cents, then your stop price becomes 130 to 140. So now you have your stop loss construction. You can already see just from this, when you look at the stop loss here, this is a terrible trade, right? That's what I'm saying. When you do this exercise, you will start to realize, am I being realistic with my goals? Am I being realistic with my stop loss? This is a very good, like before you plan the trade, you should know your stop loss, right? It will immediately put you, call you out, right? The numbers will call you out. You'll be like, wait a minute, this doesn't make sense, right? I'm paying $3 for the contract. My stop loss is at $1.20. I'm losing how much on this? $1.80? That's more than 50%. That doesn't make sense, right? You see where I'm going with this? So have these constructions, use these methods, you will get better. I promise you. Okay? These are small things, but they make the biggest impact. Okay? So that's all I have for you guys. Now, I have some closing notes, just stay for additional 2 minutes, and after that, we're all moving into Andrew's session. Just 2 minutes. First of all, for all of you that turned up for all 3 days, thank you so much, right? Even if you didn't turn up for one of the days, you still turned up for 2 days, thank you. You're really putting in the effort. I see it. It's not something that is easy to do. Sitting in this kind of environment and learning from somebody over a period of time, it's hard. I get it. But it's also required. If you really want to take your learning to the next level, you have to put in the effort. I'm a firm believer that hard work over everything. I don't care how much talent you have. You might have the talent of a million different smart people, but at the end of the day, hard work will overwork anything. Okay, you put in time, then you get the dime, right? Second thing, we have a very beautiful community at this point, guys. Okay. The collaboration between Beautiful and EGA, which is now going to become Timeless Finance, and everything that we've created in the past 1 to 2 years. After I met Andrew last year, I met him in August. We met him in California. We had a really nice heart-to-heart conversation over a burrito, which I owed him. So I took him out to lunch, and we had a really nice time. Had a couple of drinks, right? We really want to change the space for people who are feeling scared. This is the reason why my whole rebranding of EGA is all about taking out the fear in investing and trading. And you need to understand that if you are fearful, you're not gonna get anywhere. You need to remove this stigma from your mind, okay? So start thinking positively, start aligning yourself to other people who are in a similar mindset, and you will see that beautiful things will happen. More importantly, if you're the sort of person that sits in the corner and doesn't get involved, start getting involved, start talking, start putting your opinions out there, start saying something, because if you say something and you are wrong, you learn something. If you don't say anything, you don't learn. This is a very important thing, okay? So I want to say thank you for all of you that have taken part in this bootcamp. I will try to hold a couple more in the future. We always do quarterly events, and we will continue to do so. And yeah, from the deep part of my heart, I appreciate all of y'all, right? There's various ways you can get involved with both communities. Take that with your stride. You can engage in a one-on-one session with me if you want. You can take the course. You can jump on the Discord. There are so many free ways. There are so many paid ways. There are ways that obviously if my time is being consumed personally, I'm gonna need some kind of a remuneration for that. And by the way, the one-on-one sessions are priced exactly that way, right? It's not priced in a way that's like, oh, you know, this guy's just pulling a number out of his ass. It's priced to how much opportunity cost it would take for me for 1 hour, right? So I'm very fair in that way. Okay. So much knowledge gaining from these 3 sessions. You made some complicated terms seem so easy. Thanks, Steve. No problem, George, of course. I appreciate you guys very much. So we will end the session here. I don't know if you guys have questions. If you have questions, let's do something. I don't want to take away from Andrew's session. Post your questions from this session into the Discord chat room. Can we do that? If you have questions and you needed, you wrote down questions and you didn't get an answer, the public trading room, post the questions in there. I'll answer all of them. All right. So let's all hop into Andrew's Zoom here. I posted the link above, and yeah, let's take it from there. Okay. How can I join Discord? Okay, hold on. Let me give you the link. For those of you that have not joined Discord yet, I'm posting the link right now. Please don't lose this link. Thank you so much for the bootcamp. No problem, of course. Here, that's the Discord link. Just click the link and you'll be in. All right, no problem. Okay, post your questions in the public trading room. Don't be shy. Once again, just post them. All right. How do we get to Andrew's session? He posted a link on his Discord. Here, I'll post his link right now. I actually posted the Zoom link in the chat. You'll be able to see it. I'm posting it on our Discord right now. All right. I'll see you guys there. Peace.